Hello Accounting 101 students. In this video, we will highlight some of the information from our Chapter 8 student review slides. Chapter 8 has several areas of focus, and we are mainly discussing the accounts receivable account within our current assets portion of our classified balance sheet. So with receivables, companies are concerned with managing their receivables because they need to receive cash from third parties in order to continue with their operations. And sometimes they might have some customers that do not provide cash in a timely manner. So they need to estimate the allowance for doubtful accounts. This chapter also briefly discusses credit card sales. And we have two ratios that we want to calculate in assessing the liquidity of receivables: the accounts receivable turnover and the days outstanding. This chapter also goes over notes receivables and interest receivable. With managing receivables, companies have to determine to whom to extend credit. They want to determine the payment period, whether it is 10 days, 30 days, or 60 days, or any other time period. They need to monitor collections from their customers and follow up with customers that are not paying in time. And then they also want to evaluate the liquidity of receivables. And companies want to think about methods to accelerate cash receipts. And one of the methods is called factoring, which means that they're going to be selling their receivables. When it comes to valuing accounts receivable, there are two methods for accounting for uncollectible accounts. We have the allowance method, which is the main method that you want to focus on in our class. You can basically ignore the direct write-off method because the allowance method is a method that should be used. And with the allowance method, a company is going to look at their accounts receivable from their customers at the end of each accounting period. They're going to assess whether it is likely that their customers are going to pay that balance when it's due. And the losses are estimated in the same period that the sale occurs. So there's going to be better matching. And with our allowance method, we know that not every customer is going to pay 100% of the balance every single time the balance is due. So there's going to be some losses that are going to be estimated. And so our accounts receivable is going to be reduced by that estimate for uncollectible accounts. So that way our balance sheet reports our accounts receivable at its net realizable value. So the net amount we actually expect to realize or receive from our customer. And this allowance method is required by the generally accepted accounting principles referred to as GAAP. With the direct write-off method, basically we're saying that we'll write off the accounts receivable balance whenever the customer tells us that they're not going to be able to pay. But they might not tell you within the same accounting period. They might tell you 2 or 3 years later that they're not going to be able to pay. So your expenses and your revenues will not really be matched. And then your accounts receivable balance on the balance sheet assumes that you're going to receive all the money from your customer every single time, which we know that is not realistic in most cases. And the direct write-off method is not acceptable for financial reporting. So my recommendation is just to focus on learning the allowance method because that's the method that is required for financial accounting. So within your modules area, we have a couple of handouts, and I recommend going through those handouts while you're reading through the student review slides, okay? And actually taking time to write out the information in terms of the journal entries you would be recording. In this chapter, we focus on a few accounts. We're focusing on accounts receivable and the allowance for doubtful accounts, which is a contra accounts receivable account. So accounts receivable has a normal balance of a debit. So every time your accounts receivable goes up, it'll be a debit. Every time your accounts receivable goes down, it will be a credit. Okay. And the allowance for doubtful accounts normally will have a credit balance because that reflects the amount in your estimate that you think that you will not receive from your customers. So one of the things that you want to start off with is drawing out the T accounts in your handout. And in this problem, at the beginning of the period, Rose Corp had balances in accounts receivable of $200,000. So you're going to record a debit of $200,000, and you're going to record a credit in the allowance for doubtful accounts of $9,000 for this problem. During the period, Rose Corporation had net credit sales of $800,000. So that means that they're going to increase their accounts receivable balance by $800,000 as a debit, and they're going to be recording sales revenue as a credit. At the same time, the company also noticed that during the entire period, they had collected $763,000 from the existing accounts receivable balance and from the new sales that they had during this accounting period. So one of the things that you want to do for this problem is to always update your T accounts for each transaction that occurs. All right, so the next step that happens with Rose Corporation is that they wrote off as uncollectible accounts receivable of $7,300. So out of their customers that they made sales to, there were some customers that said that, you know what, we are not able to pay you our accounts receivable balance. And so the company is also going to just look at their accounts receivable balance at the end of the accounting period, and they're going to assess, what amount that they expect their customers not to pay. So this is the journal entry for the write-off, which is using the estimate that was developed in the prior period of $9,000. Okay, so we're going to reduce this $9,000 estimate because we have some customers in the current period that are telling us that they're not going to be able to pay. Because these customers are telling us they're not going to be able to pay, we're going to record a credit to accounts receivable because we no longer expect to receive that money. So that corresponds with our journal entry. And we're reducing our estimate for our allowance for doubtful accounts with a debit. Next, we find out from our customer, or a different customer, that an account that was previously written off as uncollectible was now recovered. So now we suddenly are going to be able to receive cash for an account that was written off. So this journal entry has two parts. The first part, we need to go ahead and include our accounts receivable balance back into our accounting records. Okay, so we need to include this amount back into our accounting records by recording a debit to accounts receivable. And we need to also reverse that write-off. So we're going to record a credit to the allowance for doubtful accounts. And now, since we're able to receive cash, we're going to increase our cash account with a debit. But remember, for us to apply cash, we always need to match that up with an account in the receivables area. Okay, so these two amounts, they're going to balance out with each other. But with accounts receivable, there is a subsidiary ledger, which means that there is a detailed level of account that explains what customers owe what balance, how long it's been overdue, and it correlates with each of the invoices that the company is going to generate when they make the sales. In this last slide, we are summarizing the information from our T accounts. And the main thing that you want to pay attention to here is the balance for our accounts receivable account. It's $229,700 before considering the allowance for doubtful accounts. Okay. We are going to use this amount to estimate our allowance for doubtful accounts, which is $25,000. This is going to be our estimate based on looking at our entire listing of what customers we think may not be able to pay us, and this company is going to determine this estimate. And companies have different methods of determining their estimate. Okay, so when we look for our allowance for doubtful accounts, we start off with $9,000. Then we had that write-off for $7,300. Then we have the recovery of $3,100. In order to arrive at this $25,000 estimate, we now have to record an adjusting journal entry. Okay, and the amount of the adjusting journal entry is something that you're going to calculate. So you need to calculate adjusting journal entry amount. Okay, so this is what you're calculating based on what you want your estimate to be. And also we're going to report our accounts receivable at the net realizable value, which is going to be our accounts receivable minus our estimate for our allowance for doubtful accounts. Our adjusting journal entry will be made by recording a debit to the bad debt expense. So this is the expense account that we're going to now debit at the end of the period because we need to update our allowance for doubtful accounts to reflect our estimate based on the accounts receivable balance in this period. Okay, so our bad debt expense is going to be a debit of $20,200. Our allowance for doubtful accounts, we need to increase this estimate to $25,000. So this is like the plug. This is the amount that you're solving for in order to arrive at this balance. In this chapter, we also need to evaluate the liquidity of receivables. We need to compute our accounts receivable turnover by taking the net credit sales. So usually in a problem, we're assuming that all sales are on account, that customers are not paying physical cash at the time of the transaction. And we're going to divide that by the average net accounts receivable. So you need to subtract out sales returns and discounts in order to determine the net accounts receivable and also the net credit sales. And the average collection period is computed by taking 365 days divided by the accounts receivable turnover. And a lower average collection period or fewer days is better, and a higher turnover is better. So a higher turnover means that you're receiving money from your customers a lot more frequently. There are different methods of estimating the allowance. You can use a percentage of receivables basis, or you can estimate it based on an accounts receivable aging schedule. Please refer to our textbook for details behind these two methods. Our chapter also goes over credit card sales, and basically when we record our sales revenue, we're also going to record the cash, but the cash is going to be reduced by a service charge expense that we need to pay to the credit card issuer. Please make sure that you refer to the remainder of the student review slides to practice some additional examples, and also read through the transactions for notes receivable. So notes receivable is essentially the opposite of a notes payable. Thank you for taking the time to watch this video, and please spend some time reviewing the information and practicing using the handouts included in our Canvas modules area. Thank you.